everybody. Welcome. We're going to get started in just a couple minutes here, but I wanted to just share some general Zoom reminders. We're going to have everybody stay muted and please ask questions throughout the webinar as they come up using the Q&A feature. We'll be monitoring that, addressing the questions at the end of the presentation. You're also welcome to use the chat function. You can chat with specific people, you can chat with everybody, you can chat with us. If you have any tech needs, if you're having any issues, feel free to chat me directly. My name is Kyla. You can just select my name down there at the bottom. Send me your question and I'll be happy to help in any way that I can. If you'd like to turn on closed captions for the webinar today, look to the toolbar at the bottom of your screen. Depending on when you last updated Zoom, you might have different options. There should be a button labeled closed captions or a button labeled subtitles. It might be under the 3 dots on the far right that say more. So go ahead and turn those on if you'd like. And once again, if you need anything from me, or if you have any issues, chat me directly and I'll be happy to help you out. And with that, it's 12 o'clock, so let's get started.
Good afternoon, everyone. We're so happy that so many of you have taken time during your lunch hour to join us today. We are excited to bring you the first in a series of events aimed at Provale families. At Provale, we're focused on 3 main programs, and while employment, community living, and communication and mobility are incredibly important, financial literacy and planning is an under-discussed topic. And we want to make sure you have the tools you need to set your loved ones up for success. I didn't mention, but I'm Jessica Michaels. I am from Provale and I'm the Director of Development here. But today we're lucky enough to be joined by 2 experts when it comes to planning for the financial futures of people with disabilities. First, we're joined by Katie Hurt. She's an attorney at Feeney Law Office. Katie earned her Juris Doctor cum laude from Seattle University School of Law and a Bachelor of Arts in Economics and Political Science from the University of Washington. Katie grew up in the disability community. From a young age, when her brother was diagnosed with autism, Katie honed her advocacy skills on behalf of her brother and their friends, from the playground to the classroom, to school board meetings, and now with the Social Security Administration and the courthouse. She attended the experimental education unit at the University of Washington with her brother as students in the preschool classroom, and later returned as a teacher's assistant. She understands firsthand the struggles and needs of families impacted by disabilities. She pursued a profession in law to meet some of the more complex and lesser understood needs of these families. Katie has expertise in the areas of federal, state, and county benefits and how assets, income, and special needs trusts can impact those benefits. She also has experience in guardianship, estate planning, trust drafting and administration, special education, and independent living and housing options. We're also happy to have Ian Curtis here with us today. As an associate wealth manager at Coldstream, Ian is responsible for helping clients define their financial goals and then develop a successful plan to meet those objectives. As we know, finances can be a major source of anxiety for many people, and Ian loves being able to alleviate that burden for his clients. Ian earned his Bachelor of Administration in Economics from Seattle Pacific University. He has over 7 years of financial services experience and earned his Chartered Financial Analyst and Certified Financial Planner credentials in 2019. His diverse work experience has exposed him to much of the wealth management industry and allowed him to work closely with clients in the past. Ian is part of the new cohort of Associate Relationship Managers at Coldstream and looks forward to continuing his career servicing clients in this capacity. So with that, I'd like to invite Katie to start the presentation.
Hello, everyone. Jessica was nice enough to introduce me. I'm Katie Hurt, and I will be doing the first part of the presentation today, in which we are going to briefly talk about special needs trusts, the difference between first and third party trusts, and the DD endowment trust, as well as briefly going over ABLE accounts. So if you could give me the next slide, Jessica. And I saw that that the handout, Kyla was able to provide the handout. I would also like to note that the one that you got previously has my wrong email address. So this isn't the correct one that has my new email address. So why are these financial tools necessary? First of all, I wanted to thank everyone for filling out some of the information when you signed up for the this presentation, because it gave me an idea of like who's on DDA and some familiarity. So we're going to skip through a little bit quickly. Really, these financial tools are necessary for the management of assets. The correct email listed is in the new handout. It's katie@feeneylaw.net. So the financial tools are necessary for management of assets and preservation of needs-based benefits, creating an exempt resource. As those of you who know, who are on SSI already, there is a $2,000 asset limit, which does not really lend well to being able to provide for savings for an individual or really even a financial emergency. So a special needs trust or an ABLE account is able to put money away specifically for that individual to create a little bit of a financial cushion. That is also how we direct inheritances to that individual. And next slide, please. Oops. Okay. So when we're talking about a trust, some of you may have used trusts in the past, but a trust is a legal entity created to hold assets for the benefit of a particular person or class of persons without actually giving them the assets. It is, and there's three parties in a trust. Some of these parties can hold two positions at one time, but the three positions are the trustor, sometimes called the grantor. That is the person who originally owned the asset. Then there's the trustee. That's the person who's put in charge of an asset once the trust is funded. And the beneficiary is the person who's going to benefit from that asset. A trust can be for all sorts of things. So for example, I could give a banana in trust to Kyla for the benefit of Jessica. I am the grantor or the trustor. Kyla would be the trustee. I'm telling her that Jessica can only use the banana between the hours of 2 o'clock and 4 o'clock today, because I don't particularly trust Jessica that she won't eat the banana ahead of time. So in that case, Kyla is the trustee and Jessica would be the beneficiary. So next slide, please. So the special needs trusts are broken down into two major groups. These are third-party special needs trusts and first-party special needs trusts. A third-party special needs trust means that the trustor is somebody who is not the beneficiary. The beneficiary had no right to this money before the trust was created. The trustee can be anyone who has capacity to be a trustee, and the beneficiary is a single individual with a disability who qualifies as an individual for a disability by the definition of Social Security. The trust creates rules on how the money is used. money may only be used for a supplemental purpose. That means that this money can only be used after all benefits, state and federal, that the individual qualifies for are used first, and then this money can be used to supplement those benefits. There is also what's called the sole benefit rule. It means that the beneficiary is the only person, the individual with the disability is the only person that can benefit from this trust. It's also a requirement that this is a discretionary trust. That means that the trustee has full discretion as to when money is spent. So how that looks in the trust is that the beneficiary does not have a right for automatic distributions. So in other kinds of trusts, sometimes you will see scheduled mandatory distributions. So when the individual turns 30, they get 1/3 of their trust. In a special needs trust, that is not allowed to be in there. It's also not allowed to be in there that the beneficiary is required to have a monthly allowance. That would be considered income for Social Security purposes, and therefore the entirety of the trust would be counted as a resource for that individual. And the last rule for a third-party special needs trust is that it needs to be irrevocable, meaning that once the trust is created, the only way to terminate the trust is if the beneficiary dies or if the trust runs out of money, and then the trust is terminated. All right, thank you, Jessica. The Duty Endowment Trust. Did we skip the first party special needs trust slide? Let's go back to. There should have been a first party special needs trust slide. Can you go back to the third party? Yeah. So in a first party special needs trust slide, kind of works the same. The trustor is the individual with the disability. Usually with a first party special needs trust, we see this put in place when the individual is a beneficiary of a litigation settlement. So if they were in an accident and they are entitled to damages, that is when we will see a first party special needs trust created. If the individual has a job and they are contributing to the trust from their income, that could be considered a first party special needs trust. And the other way is if somebody leaves money to the individual, not in a special needs trust. So this is when we see that the most common instance of this happening is that the parents of an individual with a disability did not create a special needs trust in their will. And when they die, or they don't have a will, and when they die, their child is entitled to a portion of their estate. And that inheritance is given to them outright rather than in a trust. And then a first party special needs trust needs to be created for them in order to preserve the benefits. The rules are mostly the same. It needs to be a supplemental benefit. It's a sole benefit rule is required. Discretionary is required. It needs to be irrevocable. But the key one for a first party special needs trust is that there is a Medicaid payback provision. That means that at the death of the beneficiary, Medicaid is the first creditor. So if there is $100,000 left in the trust at the end of the beneficiary's life, Medicaid will come in and say, well, the individual received this amount of benefit when they were alive, so we will seek to recover that amount. If there's $100,000 left in the trust and the individual used $500,000 worth of benefits, the Medicaid just recovers the $100,000. They're not going to seek to recover more than that. However, if you have something like a house in the first party special needs trust, depending on how that house is held, it could force the sale of the house to pay Medicaid back. So that is a reason why we want to do future and intentional planning before the parents die, to make sure that a special needs trust is set up in their will, so that there's not an issue of accidentally having the individual inherit money. Okay, next slide. So the DD Endowment Trust is a type of pooled trust, and I saw quite a few of you have used this. It is a combination of rules for the first and third party. Just to make things difficult, the third party trusts for DD Endowment Trust are called type 1 trusts, and first party special needs trusts are called type 2 trusts, because they just like to make things difficult. Actually, no, it's because type 1, they originally only had a third party special needs trust option for DD Endowment Trust, because they did not see a need for first party trust. But then individuals with disabilities started getting meaningful employment with good wages and wanting to put money away, and so created the first party option, or the type 2 trust option. This was also before ABLE accounts, but we'll get to that. The funds remaining in a DD Endowment Trust at the time of the beneficiary's death will be paid to the state. Similarly with like the Medicaid payback provision I just spoke about in the first party special needs trust. Next slide. So the benefits and drawbacks of a trust are, the benefit is that you can put inheritances directly into to the individual and to have some control over how that is used. And also asset management, the preservation of benefits. It also can be used as a less restrictive form of guardianship of the estate, which is now called a conservatorship in Washington State, because essentially all of the individual's money would be tied, or all of their major assets like an inheritance would be tied up in this trust, in which the trustee would be in charge of reviewing all expenditures to make sure that they are for that individual's benefit. So an example of when a special needs trust should have been used and wasn't is an example from my family. My aunt had a traumatic brain injury as a teenager, and this was in the late 60s, early 70s, and had a settlement from the traumatic brain injury incident. And when she turned 18, she just got access to all of that money. The nature of her brain injury made her incredibly impulsive, which, due to just the time, my grandparents saw more as a character flaw than as a result of a traumatic brain injury. They didn't know much about traumatic brain injuries at the time, but she then got with a boyfriend who wanted her to invest a bunch of money in one of his businesses, and basically she was completely out of money by the time she was 20. So that's an instance in which a special needs trust would have been able to preserve that money and look at when if she could go to the trustee and say, hey, I want to invest in this man's business. The trustee would then be able to look and say, hey, is this going to be a solid financial decision or not? So it doesn't mean that they can never want to invest in something. Lots of times we want individuals to invest in things and trust to invest in things. But in that case, not a great idea. Please don't do moral bequests to siblings. Speaking as a sibling of an individual with a disability, I don't want my parents to give me 100% of their estate and say, now you make sure that you take care of your brother for the rest of his life. There's a couple of reasons for that. I'm always going to be there. I'm going to be a trust advisor and a trustee for him. But if they gave it all to me, if I got divorced, all of that money would be considered part of my property. Even if it's considered separate property because it's an inheritance, it would still be considered as part of my property during the equitable division of assets. If I die before my brother does, then how do I make sure that this money continues to be for his benefit? My children are very young. So who would I give this money to? In a trust, we have provisions for that. Or if I got in a car accident and then became disabled, what are we going to do with that money? Also, if I get in a car accident that is deemed to be my fault, all of that money, my inheritance, would be deemed part of my assets, and during any judgment against me, all of that money could potentially be used in a judgment to benefit the individual who I harmed. So trusts are a great thing to hold this money. The drawbacks and costs of a trust are the actual financial cost of setting one up. To set one up is usually between $1,000 and $3,000, depending on how complicated the trust is, depending on how many iterations of it has to go through. Trusts are currently taxed at a higher rate than individuals are, so income from those trusts can be taxed. The burden of trust administration, I mean, it really depends on what the alternative to the trust is. This is why oftentimes I don't recommend people creating third-party trusts during their lifetime for the benefit of their child. I recommend putting it in the will if they just intend on providing that sort of support during their lives. And there's no money going directly to the individual. This is both a benefit and a cost. The education of trustees who are not professionals. You want to make sure that you choose a trustee who is savvy enough to know at least a little bit about what they're doing for making distributions, that they know to not make a distribution directly to the beneficiary, that they know to make the purchases on their behalf and not to give them money to make the purchase. And also that they're savvy enough to know when to ask for help, when to talk to an attorney, when to seek help from a financial advisor like Ian. Yeah. Okay, next slide, please. Okay. And in my handout, you'll see that I have like choices to consider of different types of where you can put in special needs trusts. I'm not going to go into that right now because of time. But if you have questions about those things, let me know. An ABLE account is a tax advantage savings plan. It's under the same law as the 529 plans for educational savings accounts. It's just a 529F plan, but we call them ABLE accounts. The beneficiary is actually the owner of the ABLE account. There is not a trustee. However, if the individual is subject to a guardianship, the guardian would be technically in charge of the ABLE account. The beneficiary can also, or the owner of the ABLE account can also name somebody as a signer on the ABLE account. There is a Medicaid payback provision in all accounts, regardless of who contributes funds to the ABLE account, and the money may only be used to pay for qualified disability expenses. But qualified disability expenses is like really broadly defined. Basically anything is a qualified disability expense. Next slide. Yeah, that's basically just what I said. Just now, I forgot about that slide. ABLE account limits. If the ABLE account is under $100,000, it's not countable as an asset for Medicaid resource tests at all. But each state can technically set their own limits on that. if you go to the ABLE National Resource Center, you can combine or you can compare what different states' rules are. They're a little bit different, but these rules should, these are the ones that are true for all of them. You can contribute $15,000 from all contributors to an ABLE account. So if grandma wants to give $1,000, that's fine. But if grandma wants to give $15,000 because they're trying to get money out of their estate, that's fine. But then nobody else can contribute to that ABLE account that year. Next slide. Who qualifies for an ABLE account? An owner must be an individual with a disability as defined by Social Security. They must demonstrate that they have been disabled before the age of 26 and may establish before or after the age of 26, but they must be able to show that the disability originated before the age of 26. An ABLE account, how it works varies from state to state. Some states allow for like debit cards to be taken out. Some are much more focused on being a savings plan. It's not just a regular bank account. Each state you have to work with it to see how distributions are made. With who controls the account, technically the individual with the disability is the owner unless they are subject to a guardianship or they name somebody to help with that assistance. And these accounts are subject to IRS audit, so you do want to make sure that you are keeping track of what the money is being spent on, because if they are subject to audit, you would need to show that each of the distributions was a disability related expense. I have never done an ABLE audit. I haven't talked with anybody who has had one audited yet. I don't think it's a very high priority for the IRS at the moment. But just so you know, you should keep track of it. So for example 1, the examples are in the handout. Oh man, and I'm just realizing that the footer on my handout is incorrect too. I'm sorry, I changed firms recently and I've been trying to catch where all of my old firm footers are on this, and I didn't catch it on my handout. I apologize. But example 1 is Katie gets a childhood disability benefit after the death of her parent and is receiving $1,200 a month. She pays $700 a month in rent, $40 a month for her cell phone, and $200 a month in groceries. Other than that, she doesn't have a lot of other money and expenses and would really like to save up to go on a trip to San Diego to see her sister. Without an ABLE account or a special needs trust, she may not be able to save up the money each month to buy a plane ticket because her childhood disability check essentially only allows her to have $800 in her account. It doesn't make sense for her to open a special needs trust because she's only saving a little over $100 to $200 a month. She could technically create a type 2 DD endowment special needs trust, but in this instance, I would more recommend an ABLE account to save money. Travel expenses can be considered disability-related expenditures. Example number 2, Josh was on SSI until he got a job at the courthouse doing office administrative work. He has worked hard and receives $1,280 in wages each month with the assistance of a job coach, and $135 in SSI each month. $80 are exempt from SSI reduction, and the other half of what is remaining is $600 is subtracted from the SSI total of $735 to calculate what Josh should be receiving. His total of $1,415 a month is very close to the $2,000 limit. that he needs to remain under, not just for SSI, but more importantly for his job coach to continue to be eligible for. In this instance, Josh could establish a special needs trust, but again, it might make more sense for him to forego the expense of setting up a special needs trust to set up an ABLE account. And again, this would really depend on whether or not Josh was eligible for DDA services. This would also be an instance of that a special needs trust through DDA may be appropriate as well. Example 3, Erica has Down syndrome and receives SSI and does not work. As Erica is in a car accident and the portion of her settlement from the accident is $200,000. Erica can't put that money into an ABLE account for a number of reasons. It is more than $15,000 maximum annual contribution, and $200,000 is more than the maximum amount that an ABLE account can hold in Washington state, and more than an ABLE account can hold if she wishes to remain eligible for her SSI benefits. In this case, I would recommend that Erica either deposit the entire amount into a special needs trust or contribute most into a special needs trust and deposit some of the settlement into an ABLE account. And our last example, example 4, James is an individual with cerebral palsy and intellectual disabilities. He is 20 years old. And, oh, I'm sorry, the examples are on the worksheet that was sent out, and it was the link to the worksheet is in the comments. Thank you. James is an individual with cerebral palsy and intellectual disabilities. He is 20 years old and receives SSI. James's paternal grandparents give him $5,000 to each of their grandchildren every year for their birthday, but they haven't been giving that to James because they are worried about negatively impacting his benefits. They would also like to leave James a portion of their estate when they die. Could be as little as $12,000, could be as much as $40,000, depending on how long they live. In this case, either an ABLE account or a special needs trust could be a good option, but I would advise a special needs trust in this instance. The grandparents could contribute the $5,000 every year to an ABLE account, and that still leaves plenty left of the maximum of $15,000 per year for other contributions. However, the ABLE account has a Medicaid payback provision. A third-party special needs trust does not have a Medicaid payback provision, so that would be advisable in my opinion. The third-party special needs trust also can be referenced in the grandparents' wills, and inheritance would go directly to the special needs trust rather to James directly and then need to be put into a first-party special needs trust. So you can avoid that by just naming the third-party special needs trust in your will. Doing so ensures that even if James's share is over the annual maximum, he would still be able to receive the entire amount without negative impact on his benefits. If the client wants to have an ABLE account, a paragraph can be added to a special needs trust to allow for distribution to an ABLE account. And in this case, it also is important to talk about where you talked about the Medicaid payback provisions are like what happens when the individual, the beneficiary dies. With the Medicaid payback provision, essentially all of that money is going to go back to the state. But with a third-party special needs trust, you can name who you would like to receive the benefit after the death of the beneficiary. And the examples aren't in the link. I think that maybe Kyla can help you with that. But yes, a third-party special needs trust, you can name who is going to be the beneficiary or the receiver, or oh my gosh, the beneficiary after the individual's disability dies. Oftentimes people will sometimes name their other children, their grandchildren, or you can also name a charity. And this is where I'm going to hand it off to Ian to talk about financial management and also how to name maybe different charities and why you would perhaps want to do that.
All right, thank you, Katie. So yeah, as Katie alluded to on the previous slide there, yeah, there are a number of situations where it may make sense to do charitable bequests with whatever is left over in a third-party special needs trust. And that's where we'll start this portion of the conversation. And then we'll look at some situations where other strategies might be more appropriate, talk through the pros and cons, and when certain situations might dictate taking one course of action over another. So of course, the primary consideration should be supporting organizations that you're passionate about, and this is a great opportunity to do it. Secondary to that would be the tax benefits that can result. So we'll look at a few strategies. First, we'll talk about leaving charitable bequests directly to charities through your estate, then talk about leaving assets via the remainder as remainder beneficiaries of the trust, and then lastly take a look at utilizing retirement accounts for that purpose. So let's go down to the next slide here. Okay. So a strategy that can be, really appealing for a lot of families is to set up a charity as the remainder beneficiary of a third-party special needs trust. And what this would really mean in practice is that the only dollars that would flow through to charity would be whatever is remaining at the beneficiary's passing. So to the extent that there are leftover assets after your loved one has been provided for by the trust, whatever's left over at that point would pass to charity. And this ensures that those charitable bequests are secondary to providing for your heirs. So there are some benefits there. In certain circumstances where an estate is large enough, though, this could be suboptimal from a tax standpoint, could result in a larger estate tax burden. And so we'll take a look at some of the other strategies that could be utilized if you determined that there was sufficient net worth in your estate to dictate a different approach. So listing charities directly in your will, this would be more tax efficient if you have a taxable estate, because essentially if you're utilizing charities as remainder beneficiaries of the trust, it's not going to reduce the amount of assets that's considered part of your estate for estate tax calculation purposes at your passing. So if you are highly confident that your estate is large enough to fully meet the needs of your beneficiary, then you could very easily take some excess portion of that and direct that specifically to charities at your passing, as opposed to leaving it through the trust down the road, which could carry some benefits. The other situation that often applies, if we go down to the next slide here, is in situations where there is a large balance that's held in a retirement account. So generally speaking, there are exceptions to this, but by and large, most retirement accounts are full of pre-tax dollars, so dollars that are going to be subject to taxes when they're withdrawn from the account. And what that means is that if those are going to a beneficiary other than a charity, the beneficiary is going to pay taxes on that money as it comes out of the account based on their ordinary income tax rate. And so one strategy that I often see employed is setting up charities as the beneficiaries of retirement accounts so that you're able to pass a larger amount net of taxes to the organizations that you care about, as well as your heirs. So really, a lot of different potential strategies here. So much of it depends on the specifics of your family and what the needs are going to be of your heirs down the road. First and foremost, you want to make sure that you're setting aside sufficient assets to fund their needs, and that can be done in tandem with all of the professionals in your life. It's important to have good care planning done to make sure that you're getting those numbers right and putting the right amount into trust. To the extent that there's excess, you can begin thinking about some of these other strategies to optimize things from a tax standpoint. So that is everything that we had prepared today. And now Katie and I will just open it up to any questions.
So we did have one question earlier in the chat. Let me grab it. So this question was directed at Katie. And it says, did you just mention that the fund dispersed from the third-party trust fund is taxable, even though the fund is used directly to purchase a service or an item? Katie?
And what I meant by that is that, and Ian can probably speak more to this than I can, but that if a trust is investing and the trust is earning income, then that is what is being taxed. And the trust is has its own EIN number that's similar to like a social security number. The trust pays taxes by itself. So Ian, could you speak a little bit more about that?
Yeah, I think you nailed it, Katie. So the important thing to be aware of is that, yeah, this is a taxable entity and does have its own tax brackets that apply. So if the funds within the trust are being invested and producing income and capital gains, yeah, that will be taxable income that needs to be reported.
Thanks, guys. We have another question from Krista that says, can the cost of a special needs trust be funded by the disabled individual, and can monies already in an ABLE account fund a trust?
And so let me answer what I think that you're asking, and if I'm answering the wrong thing, please clarify. So the cost, yes, can be covered by the individual. So what I think is what I'm hearing is that if the individual wants to set up a special needs trust, the individual with the disability, yeah, they can pay for it themselves to cover the cost of setting it up. Oftentimes when an individual is the beneficiary of a large settlement, like I talked about, if they were in an accident of some kind, they receive a settlement of, let's say, $200,000, that $200,000 can be used to cover the cost of setting up the trust. Additionally, in all of my trusts, I include provisions that the trustee can hire professionals to assist with the administration of the trust, such as hiring a financial advisor like Ian's firm or hiring an attorney like me to advise the trustee on how to use the trust, and our fees can be paid for by the trust. So the trustee does not need to pay for those services directly, because it is still for the benefit of the beneficiary. And can an ABLE account fund a special needs trust? I think so, but I can't imagine why we would want to do that. If it's already in an ABLE account, I would leave it in an ABLE account. Because you're not going to get away from the Medicaid payback provision, because it's already first party funds. So I'm not sure why we would transfer it from an ABLE account to a special needs trust, but a special needs trust can fund an ABLE account. A reason to do that is that ABLE accounts can be used for rent and basic food and shelter costs, whereas a special needs trust specifically cannot be used for rent.
Okay, we have another question from Mike. If an ABLE account was originally set up in another state before Washington had an ABLE account, is there any advantage to moving the trust to Washington?
There is an excellent resource for this, and I will look it up and put it into the chat. The ABLE National Resource Center has a page where you can compare different states and what each of them do. So like I have used ones in Utah, Oregon. I advised a lot of clients to use the Oregon one before Washington had theirs, because Oregon's is really, really similar to ours. Also, Washington State doesn't have an income tax, and that is one of the big reasons why people want to use like their state, is to avoid certain state income tax consequences. But Washington doesn't have income tax, so I will drop the link, and then you can see for your individual case if it would make sense to switch to Washington.
Okay, we have another question from Gary. 2 years ago, when doing our triennial guardianship report, we were told we had to pay $150 annual bond because we had an ABLE account. Could you explain why that came about?
So, Gary, I can't answer your specific question, and I forgot to explain this at the beginning of the presentation. I'm not able to answer like very specific questions because it gets to the edge of where providing legal advice, and in this forum, I'm not allowed to provide legal advice. I would need to look at. I would need more information specifically about why a bond was required in that case, but I will say that in Washington State, if an individual has more than $3,000 that they have ready access to, meaning that it's not in a trust, that they will have to pay, that the guardian has to pay a bond. Bonds are something to protect that if the guardian has easy access to the individual's accounts, that if the guardian clears out the account and runs away with it, it is an insurance policy to make sure that that money is able to be recovered.
Great. Joe has a question. How much can you put into a special needs trust before it affects benefits?
Unlimited. You can put as much money in a special. I have worked with special needs trusts that have as little as $20,000 or $10,000 as much as $20 million. Like, I mean, it's unlimited.
Great. Another question, if we have significant values in our rental houses, how is best to transfer to my son when we pass away? His sister will be a stand-in guardian for him.
So again, I can't answer specific client questions because that gets to the edge of legal advice. What I can answer is that for how are properties treated with special needs trust. You can put a property into a special needs trust. There are potential risks of if it is a first party special needs trust that it could be subject to the Medicaid payback provision. And a third, I should mention, a third party trust can be converted into a first party trust if it is mishandled, meaning that if the trustee starts putting the beneficiary's money into a third party trust, Social Security is gonna notice. I know because I've had these cases. And then we have to go back and essentially revise the trust to make it a first party special needs trust. For a third party special needs trust, you can have a third party special needs trust hold property, but there can be some tax consequences. Ian, do you have, can you speak to that at all?
Yeah, so I think one thing that I would consider here too is the, as it relates to the Medicaid payback provisions and first party special needs trusts, you know, you do have a certain amount of equity that an individual can have in their primary residence without disqualifying them for Medicaid. So in my mind, I do see some benefit actually to potentially splitting the ownership between the individual up to the Medicaid limit and then maybe holding the excess in the special needs trust as a way to circumvent that. Any thoughts on that, Katie?
Yeah, I agree. That this is one, when it comes to property and putting property in trust and dividing between siblings or dividing between different individuals, this is something that is definitely a very specific legal question of what are your goals for your family? What are your goals for the property? Do you want any of the people to be living in those properties? Do you want them just to be income generating property? There's a lot of questions when it comes to things like that.
Another question. My friend wants to give us some stock from his company that will be worth a lot of money in a number of years. Can you put specific stocks in a third-party trust?
Yeah, absolutely.
But again, it's one of those questions of that if these stocks increase dramatically in value, you will want to look at tax consequences.
Yeah. Well, and one thing that I'll elaborate on there too is that it is important to note that with a third-party special needs trust, to the extent that income is distributed to the beneficiary or used for their benefit, that portion that's distributed on an annual basis can be taxed at their individual rate instead of being taxed at the estates and trust tax rate. The problem is you could easily find yourself in a situation if the trust is large enough where there just aren't sufficient expenses to necessitate that level of distribution from the plan, and therefore you could end up with a significant amount taxed at the estate and trust tax rates.
Okay, great. One more question. What would be reasons or consideration to use the Washington State Endowment Trust funds versus setting up a trust fund with an attorney? Are there pros and cons? Okay, so that was question number one, and there's a second part of the question. So go ahead and answer that, and then I'll
and I see the question. This is a great question, because I have worked with lots of families where we use lots of different options. I have clients who have private established third-party special needs trust, but they also have a DD endowment trust. And the DD endowment trust is awesome. I will say, they invest very conservatively, but the money grows. It is managed by the ARC of Washington and an advisory board. If you don't have somebody who you really trust to be a trustee, the DD endowment trust is a great option. It costs essentially nothing to set up. You can get it if you are a DD, if the individual with a disability is a DD client. And it is really good for use as a savings account, meaning that I think you can, somebody can correct me if I'm wrong, I think you get 6 file pulls a year. And what that means is that you can ask for 6 distributions from the trust a year, from a DD endowment trust a year, with no penalty and no service. I shouldn't call it a penalty, with no service charge. And if you want more distributions than that, you still can get more distributions. You just have to, it charges a fee for each time they have to pull the file to make a distribution. So if the individual just wants to do this for buying a new couch in January and going on a vacation in or paying for the individual's vacation to Hawaii in May, and for some Christmas present, or for not Christmas presents, but for another large expenditure for a new kitchen table in November. The DD endowment trust is great because that's 3 distributions. The issue with the DD endowment trust is that typically you have to have a named person who is making the expenditure, and they are requesting reimbursement. That's the smoothest way I've seen it used. So you do need to have somebody who is able to make that expenditure on their own behalf. It's usually not the beneficiary who's making that expenditure. It's like a sibling or a parent who makes the expenditure and then are reimbursed by the trust. My family uses the DD endowment trust. We really like it. But also, I highly, highly, highly recommend that all parents create a third-party special needs trust in their will. Even if you name the deed endowment trust, you don't necessarily, the funds remaining at the end of the lifetime of the individual, it's a lot easier to dictate where that money goes with a third-party special needs trust that's created in your will. Also, for a large amount of money, like an inheritance, I would recommend getting a financial advisor like Ian's firm or another financial advisor that your family is comfortable working with, to not necessarily do like the most conservative, but an investment plan that is tailored to your family member and their lifetime and what their needs are. Ian, did you have anything to add to that?
No, I think you nailed it.
Great. So the pros of getting a DD endowment trust is that there's a great savings account. It has a good rate of return, and it's somebody else's administrative problem. And it also basically costs nothing to set up. The cons are you don't have as much control. You don't. There's only 6 distributions a year. So if you're planning on making more distributions than just 6 a year, then using the private setup special needs trust is better. Also, if you don't have somebody who can make the expenditure and then request reimbursement, that you rather just want the trust to pay directly for it, the privately set up special needs trust is a better option. Yeah. So the second, oh, go ahead, Kyla.
Oh, I was just going to read aloud the second half of the question.
Yeah, please.
Are trust funds for the average Washington family, or are they geared more to the, say, top 25% of income families in Washington state?
So I would say that the DD endowment trust is definitely geared at anybody getting close to that $3,000 or the $2,000 limit. I mean, they essentially cost nothing to set up. They are a great savings account. Same with the ABLE account. I only recommend setting up an ABLE account if the individual is like earning money and it is like their personal savings account. That is when I recommend getting an ABLE account. And like I said, I recommend that every parent who's going to be giving money to their children set up a third-party special needs trust in their will. It's a good way to set up a savings account to clearly identify that this money is for my child with a disability. My other child received their inheritance and that's in their account. And maybe my other child is going to be the trustee for this account, but it is very clearly separate. It is not my typically developing child's money. This is clearly my child with a disability's money, and it is for their benefit. Even if it's $5,000, $10,000, I recommend doing that. If they spend through it for the benefit of the individual, then it terminates. I mean, that's what I recommend. Ian, did you have anything to add with that?
Yeah, I think, when people hear trust planning, I think there is an inclination to think, oh, this is really only stuff that applies to the ultra wealthy. But the reality is, with the situations that we're talking about here, the threshold for how much an individual with a disability can have in their checking or savings account kicks in at such a low level that this is really important planning for really any family to be doing if there's an individual living with a disability.
I think we're coming up to time. I don't know if anybody, if you could go to the next slide, Jessica.
We got one last minute question. Do you guys have time?
Yeah, I have time for one more.
Okay. Individuals who qualify to live in supported living homes, is it very common for them to successfully have full-time earnings? Or do most individuals have a guardian or a parent to make most financial decisions?
I mean, I don't think that those things are mutually exclusive. I'll just speak about my brother who lives in an adult family home. He is employed full-time at Microsoft with the Healthcare for Workers with Disabilities to continue to qualify him for his DDA services that allow him to live in his adult family home. And he has a guardian. So all of those things can be true all at the same time. I mean, what is most common? I can tell you that all of his roommates, he has 5 roommates, all of them also have employment. Yes, and somebody just made a comment, just as a comment for DDA endowment trust fund distribution, the family of the conservator can ask for one lump sum reimbursement for several expenses and don't need to ask for reimbursement for each occurrence. That's accurate. So like when I said that you get 6 distributions a year, you can submit lots of receipts with each of those distributions. So yeah, like I have clients who they just organize it every 2 months, and then every 2 months, so it equals out to 6 distributions a year, they submit reimbursement requests to the trust. Usually they don't need 6, but just to kind of go through their expenditures to see if they need reimbursement. And we are at 1 o'clock. I just wanted to direct you to our disclaimer notice because attorneys and financial advisors need these types of things, that this is training and educational material only. None of this was designed to be direct legal advice. Oh, and I'm sorry, it has my previous law firm on there, Cassidy Monero. I just transferred from Charlotte Cassidy's office. We are still on excellent terms, but I am now working with Feeney Law. But so my apologies that, I mean, it really did just happen. So my apologies for Cassidy Monero still being on a lot of these materials. My office is Feeney Law now. All right, well, thank you, all of you, for participating and your excellent questions and comments. It really is much more fun when people engage. That's why we kind of try and race through the material so that we can get to your questions. And we really hope that this has been informative and helpful for you guys.
Thank you, everyone. Have a good afternoon.
Thank you, everyone.
Thank you.